The blow by blow here as things play out, but recession is still not your base case, is it? Or maybe it is now.
Well, no, it's not. It was a week ago. But as you said, the cancellation of the reciprocal tariffs on most of our trading partners was a positive event in that it did highlight that the administration is willing to negotiate. And so we didn't know that. And so that takes some of the uncertainty out. And indeed, uncertainty has also stabilized. It's very, very, very high, but it stopped going down. And energy prices are lower, although they're up a little bit today. They are down significantly, an important tailwind going into the second quarter when you get these spikes. So we actually dropped the odds from 55 to 45% chance of a recession. We're now using stall speed. And again, that energy thing is really important, that energy drop, because that's going to buffer the hit to overall consumer prices from the tariff hike, which will be severe, and you'll see it in core goods in particular. But net headline inflation will probably be about 3% in the second quarter. Within it, core goods could be about 6%. But again, energy is really a positive tailwind for the consumer. Capital spending, last point, capital spending is likely actually to get pretty hard, though. We call it stall. On balance, GDP will be stall speed. Some growth in consumer spending by the high-end consumer, but capital spending is likely to be down 3%-ish because there we also import a lot of capital equipment from China, and you're likely to see a sharp spike in capital equipment prices, really holding back CapEx in 2Q and most likely into 3Q. And forget about housing in this environment, right? With mortgage rates back up, consumers certainly concerned about the job market. Housing will also be on the weak side. So no, we've changed stall speed from a recession in just a week. Yeah, it's a pretty risky environment, and we could certainly change that next week.
Before I bring Mike in here, Nancy, it's funny because we seem to always talk to you on Fridays when we get the consumer sentiment survey. So I think literally the last time we touched base was when we were trying to dissect it. The headlines this morning from the report are horrendous. There's a huge debate going on about what you should take from that. Maybe the market can take it as a bottoming signal because it can't get much worse. It's more important politically than economically. It has no correlation to spending anymore, are among the takes that I've heard. So I just wonder if you could sort out for us, is this politically biased or no? Is it a real useful data point on the consumer, on the economy, on markets?
Some components of the UMich survey are useful. The headline and the three main components by income quintile and by party. There's a huge problem, apparently. They have a component that is now weaker than the GFC. If you're a Democrat, you think inflation is going to be 7%, and you think the economy is worse than it was during the GFC, let alone COVID. We have our own daily consumer confidence survey, and it actually rose today and is not egregiously down significantly. And so there seems to have a slight political bias to it, where ours seems to be a little bit more balanced. Consumer confidence is edging down, but it certainly isn't declining significantly.
All right, Mike, let me turn to you then and talk a little bit about the internals of the market this week. The worrisome combination has been that the stock market sell-off broadly has occurred while the bond market has also been selling off. The dollar is weakening, gold is strengthening. And a lot of this is read as maybe the flip side of these high China tariffs, meaning if you kind of grind trade to a halt, do you grind international finance to a halt? Do you grind that recycling of cash into the bond market to a halt? Do you worry about these developments, or do you think that we're all making too much of them?
We do. We really worry about the downside risk, and we are pricing in a recession for the second half of this year. The sentiment numbers that we're seeing from the consumer are leading to weaker activity. So in the inflation data that we got this morning on PPI, yesterday on CPI, airline fares, hotel prices have plummeted. And that's a sign that the consumer is pulling back already on discretionary items ahead of concern about tariffs. And on the energy sector, yes, lower energy prices are good for the consumer, but you have to remember that the U.S. is now a net exporter of energy. So the U.S. is a big energy producer. We saw in 2015 when energy prices went down in 2014 that it hurt the U.S. economy. Yes, it might help the consumer, but energy producers, which is a big segment of the U.S. economy, do get hit, and that leads to job layoffs.